Welcome again to Shine's Trading Room. Today we have Jim Riggio. He's a true options master. We are going to go into a few other strategies of his as we've done already. You can see them all on shinestradingroom.com. Today the topic that we're going to go over are straddles and strangles. This might be a little more advanced. I want to get the trading community to have a better understanding of what the options market is really like. What are the different opportunities? What are the options in options? So we're going to go into straddles and strangles today. I'm going to pass the mic over to Jim. Jim, welcome, and you can take it from here.
Thank you. Two strategies that are often talked about, but sometimes misunderstood by a lot of people. Basically, what a straddle is that I am going to buy a put and a call at the same price. So let's stick with our IBM example again. Let's say it ends up going down to 175 like we talked about, and I think it's going to end up moving. Where's it going to end up moving? I don't know. It might go up, it might go down, there might be events, and I think it's going to be a move, and there's going to end up being a big move. So I may want to end up buying a put at 175 and a call at 175. What your P&L would end up looking like is that you'll need the stock to move far away from 175. So we talked about Greeks a little bit before. I'll end up being long gamma. Remember, that'll end up meaning that I'll make more and more and more money if we get away from 175. So the P&L graphs that we looked about in IBM, if we were at 175, if we end up moving away from it, we'll end up making money. But remember what will happen? What happens if it stays at 175? We're going to end up paying our rent, and we're going to lose a little bit of money every single day. Now, one of the things before everybody runs out and buys a straddle, I'd end up saying, you need to end up thinking about why you're doing it and how you're doing it, because you're not the only one in the world that says, oh, I think it's going to move from here, and therefore I'm definitely going to buy it. Well, when there's a news event and you think that it could end up moving in a lot, what'll happen is that the price of that straddle might get very, very expensive. So in that case, you may want to say, well, I think it's going to move, but it may not move too much. In our example before, where it was, if the put and the call were $3 at 175, now think about that. At expiration, it needs to end up moving in a $6 range, because that's what you paid for it. So now it has to get above 181 or below 169. That's a pretty big range. But if you think it's going to move, you want to buy the straddle. If you think it's going to end up not moving, you want to sell it. By the way, the only big difference, or the only real difference between a straddle and a strangle, is in a strangle, we're going to use different strikes. Okay, so in a strangle, we might use the 170 and the 180. We buy the 170 put, we buy the 180, we buy the 170 put, we buy the 180 call. In a strangle, okay, that's what it is. We buy the same strike. Straddles are the same price, strangles are the different price. I misspoke, I apologize. Okay, so that's basically the difference. If you think a stock's going to move, you're going to want to end up buying them. If you think it's going to move more than the expected value of what you're paying for it, you're going to want to buy them. If you think it's going to move but not that much, you're going to want to sell them.
Quick question for you, Jim. Is there a way to make money on both sides of a straddle?
Meaning that if it runs up or runs down?
On both sides, because you're long a put and you're long a call.
Right.
So are you able to make money on both sides of that, or does one always have to expire worthless?
It can end up happening not at expiration. I mean, there are instances when something may run up and you end up, selling your call, or you sell pieces of it, and then when it runs back down, you could then end up selling some of your puts. By the way, professional traders, which David ended up bringing up, that's called gamma scalping, and it's a good example that maybe we'll talk about next time.
Okay, thank you, Jim.
Thank you.